Hello, I'm Chris Kong, National Managing Partner of PwC Canada's tax practice. As 2015 is an election year, there will be great interest in what the federal government's pre-election budget might hold in store for us. Before we look ahead to what tax measures might be in the 2015 budget, let's look back at the progress the government has made in fulfilling its tax agenda. The government has followed through on its commitment to stay the course and not increase federal personal or corporate taxes. In 2014, a number of changes were announced to close down what the government perceived as loopholes. These integrity measures, as described by the government, were intended to make the Canadian system fairer. Some were directed at certain types of international tax planning. Other measures ensured that people immigrating to Canada cannot use immigration trusts to reduce Canadian tax. The government had also committed to eliminate the deficit by 2014 and 15. In anticipation of achieving this goal, the government made good on some of its outstanding promises to taxpayers this past October when it introduced a form of income splitting, doubled the children's fitness credit, and made this credit refundable. So what might we expect in Budget 2015? We expect that in keeping with the government's agenda, there should be no new taxes and no increase in personal or corporate federal tax rates. As a pre-election budget, there's a very good chance the government will announce additional tax relief for Canadians. We might see more tax breaks for individuals that were promised, but have not yet been delivered. For example, a possible increase in the maximum amount that Canadians can contribute to a tax-free savings account each year to $10,000. A clear focus for our government going forward is the work of the Organization for Economic Cooperation and Development, or OECD, and the G20 countries on base erosion and profit shifting, also known as BEPS. The OECD uses this term to describe tax planning strategies that minimize a corporation's overall tax, such as the shifting of tax profits to low-tax jurisdictions. Although this type of planning has been acknowledged to be completely legal under current laws and tax treaties, it has recently been the focus of a lot of media coverage. Budget 2015 may give us a sense of Canada's initial views on the OECD's deliverables on BEPS. Our hope is that Canada's views will take into account what the OECD's proposals mean for Canadians and Canadian companies. The budget may also bring more details on the 2014 proposal to replace the eligible capital property system with a new capital cost allowance class. And we may learn about where the government is heading in respect of income tax exemptions and reporting requirements for nonprofit organizations. Here are 3 ways to stay informed about the upcoming 2015 budget. First, please refer to the budget page on our PwC website. Second, be sure to subscribe for a budget memo. You can use the Stay in Touch form on our website to do this. And last but not least, we will be more than pleased to discuss with you what the upcoming budget could mean for you or your business. A list of PwC contacts in each city is available on our website. Thank you.